There's a couple in Indiana, both retired, both in their late 60s, who haven't paid a dime in federal income tax in 4 years. Not a dime. They're not wealthy in the way you might imagine. No offshore accounts, no trust fund, no team of tax attorneys billing by the hour. He was a high school teacher. She worked in a dental office. Their combined savings at retirement was under $500,000. And yet, legally, deliberately, year after year, their tax bill comes to exactly zero. The first time I heard that, I didn't believe it either. I assumed there was a catch, some deferred liability, some future reckoning. But when I dug into the actual structure they built, I realized something that upended everything I thought I knew about taxes and retirement. The tax code doesn't punish retirees who've saved a fortune. It punishes retirees who take their money out in the wrong shape. And if you understand the difference between taxable income and the right kind of income, you can walk through a door that most people don't even know exists.
I'm not a tax professional. I'm not a CPA. I'm not the guy who prepares returns for clients and wears a crisp shirt while doing it. I'm someone who spent most of my working life assuming that taxes in retirement were just a slightly gentler version of taxes while working. Smaller, maybe, but inevitable. A background cost of existing. What I eventually learned, through my own mistakes and a lot of late nights with tax schedules I barely understood at first, is that the line between paying something and paying nothing isn't about how much you've saved. It's about which buckets you draw from, in which order, in which years. And the window for setting this up is not infinite. In fact, it's closing for a lot of people right now, and they don't even know the deadline exists. But I'll get to that. First, I need to tell you about the year I received a tax bill that broke something open in my brain. It wasn't the biggest bill I'd ever paid. It was the most unnecessary. I was 64, officially retired, and still learning the terrain of my own finances. I had a traditional IRA, a small Roth, and a brokerage account with some mutual funds. That year, I needed about $55,000 to live on. I pulled it from the IRA because that's what felt obvious. The IRA was my retirement account. Retirement accounts are for retirement spending. Logical.
The bill came in February. Between the IRA withdrawal, a few capital gain distributions I hadn't planned for, and the way those pieces interacted with the Social Security taxation formula, my effective tax rate wasn't zero. It wasn't close to zero. And what stung most wasn't the check I wrote. It was the realization that had I pulled that same $55,000 from a different combination of accounts, I could have paid nothing. Legally, completely. The IRS would have looked at my return and said, "You owe us nothing. Have a good year." I didn't know that was possible. And I didn't know because every piece of retirement advice I'd absorbed was about accumulation. Save more, max the 401k, defer, defer, defer. Nobody handed me the withdrawal playbook. So I handed myself one, retroactively, painfully, and it reshaped every decision I've made since. The core insight, the thing that Indiana couple understood and that took me too long to learn, is that the tax code divides your retirement income into 3 distinct buckets, each with its own treatment. Understanding these buckets isn't advanced planning, it's basic literacy. And yet most people enter retirement without ever having the 3 explained side by side.
Bucket 1, tax deferred. This is your traditional 401k, your IRA, your 403b. Every dollar you withdraw is taxed as ordinary income. Doesn't matter if the market doubled your money. Doesn't matter if you held the shares for 30 years. When you pull it out, the government treats it like a paycheck. This is the bucket most of us were trained to fill first, and it's the bucket that, if mismanaged in withdrawal, creates the tax bills that keep people up at night. Bucket 2, tax-free. This is your Roth IRA, your Roth 401k, health savings accounts used for qualified expenses. You funded these with money you'd already paid taxes on. And now, this is the part that still feels almost subversive to say out loud, the growth and withdrawals are tax-free. Not tax-deferred, tax-free. Zero. As in, the IRS does not ask for a cut. As in, $1 in a Roth is worth more than $1 in an IRA, because the Roth dollar is already yours, fully, with no future claim against it. Bucket 3, taxable. This is your regular brokerage account, your savings, your CDs, your inherited money. Here, the tax treatment is more nuanced. Long-term capital gains and qualified dividends get preferential rates. Some of those rates, depending on your total income, are 0%. Not low, 0. For 2025, if your taxable income as a married couple filing jointly is under roughly $94,000, your long-term capital gains inside that window are taxed at nothing. Not a percentage, nothing.
Now, here's what happens to the typical retiree who followed the standard playbook. They spent 40 years shoveling money into bucket 1 because they were told to defer taxes. They arrive at retirement with $800,000 in an IRA, maybe $40,000 in a Roth, and a modest taxable account. When they need money, they go to the biggest pot, the IRA. Every dollar lands as ordinary income. By the time Social Security kicks in, their reportable income is high enough that it triggers taxation on their benefits. Their marginal rate climbs, their Medicare premium gets adjusted upward. They're not being punished for being rich. They're being punished for having all their money in the wrong bucket. The Indiana couple I mentioned, they had the same total savings as many of their peers, but their money lived in a different shape. They'd spent the years just before retirement doing something called tax bracket arbitrage, converting chunks of their IRA into Roth while staying inside the 12% bracket, so that by the time they stopped working, they had significant money in bucket 2. Their taxable account held assets with minimal embedded gains, and their IRA was small enough that required minimum withdrawals weren't a threat. In a typical year now, their income from Social Security is below the threshold where benefits get taxed. Their capital gains fall inside the 0% window. Their Roth withdrawals are invisible to the IRS. Their taxable income after the standard deduction is negligible, and their tax bill is 0. Not because they hid anything, because they spent 5 years structuring before the payoff began.
So let's get practical, because the idea only matters if you can act on it. The first move is to know the thresholds. The standard deduction for a married couple over 65 in 2025 is somewhere north of $30,000. That means the first $30,000 of combined taxable income disappears before any tax is owed. After that, the 10% and 12% brackets cover the next large swath of income. If you can keep your taxable income inside those lower brackets and source the rest of your spending from buckets that don't register as taxable income, you can live on far more than $30,000 while reporting almost nothing. The second move is to reframe what a Roth conversion is. Most people hear Roth conversion and think it's about growth. Pay taxes now to avoid taxes on future gains. That's true, but it's not the main reason to do it in your retirement. The main reason is to build a reservoir of tax-free withdrawals you can tap in years when additional taxable income would trigger a cascade. Higher bracket, Social Security taxation, IRMAA surcharge. A Roth conversion isn't a growth play, it's a circuit breaker. It lets you control your reportable income with precision, smoothing the bumps that the conventional withdrawal order creates.
The third move, and the one that genuinely surprised me when I first mapped it out, is to stop thinking of each year in isolation. The tax code looks at you annually, but your withdrawal strategy needs to look at a 20 or 30-year horizon. There will be years when it makes sense to report more income, to fill the 12% bracket intentionally with a Roth conversion, because you'd rather pay 12% now than 22% later when RMDs hit. There will be other years, after the conversions are done and the IRA is tamed, when you can report almost nothing and live off Roth and taxable money with 0% capital gains. The zero tax year isn't a one-time prize you earn. It's a recurring option you build by sequencing your buckets correctly across time. Now, there's something I've been alluding to that I need to bring forward because it's the part of this conversation that doesn't get nearly enough attention. And it's the ticking clock.
The current tax brackets we've been talking about, the 12% bracket, the enlarged standard deduction, the 0% capital gains window, they exist because of a law that was always designed with an expiration date. Whether that expiration gets pushed back, rewritten, or allowed to hit, the point is the same. These numbers are not permanent features of the landscape. Congress can change them. And if history is any guide, the direction of change over a long retirement is rarely downward. That means the years when you can convert IRA money at 12% or harvest capital gains at 0 might not be available for as long as you think.
This is where most videos would tell you to run a Monte Carlo simulation or hire a tax strategist. And you should, absolutely, before making any irreversible moves, talk to someone qualified. But the thing you can do tonight, right now, at your own table, is simpler. Write down what you expect to spend in a typical retirement year. Then write down which accounts will supply that spending. Then, with a tax calculator or a knowledgeable friend, estimate how much of that spending lands on your tax return as income. If the number looks high, you know there's work to do. If the number looks low, you might already be closer to 0 than you realized. Either way, you're no longer guessing. You're engineering. I'll ask you something I haven't asked before, and I'd love to hear your honest answer in the comments. What's one thing about the tax system that you assumed was true for years, only to later realize it worked differently? Not something you read in a textbook, something you lived, something that cost you or saved you and shifted your understanding. Share it. Someone scrolling through those comments needs the exact perspective you're holding. The next video goes somewhere most financial conversations avoid entirely. Because for all the strategy around accounts and tax brackets, there's a deeper question that rarely gets an honest answer. In retirement, which actually puts more money in your pocket? Owning real estate or owning stocks? Not which one feels safer, not which one your uncle swears by. The real, after cost, after tax, after sleepless night truth about which asset class pays you more. I'll break it open next with a framework that flips the whole debate. Watch that before you make one more assumption about where your retirement income should live.